Hello and welcome to BQ Prime. I'm Hiral Dadia. One stock from the banking space that is in focus today is Yes Bank. And it's clearly aging-related provision that's dragging the earnings lower. There are concerns coming in with regards to AT1 bonds as well. Now, what this would mean actually for the stock, the company, and the investors. Joining us on the show to discuss the same, you have Aditya Shah, who is the Chief Investment Officer at JST Investments, joining in. Welcome to the show, Aditya, and a pleasure to speak to you.
Thanks for having me here, Hiral.
Aditya, my first question coming to you is overall, let's quickly start off in terms of where earnings are concerned. Now, overall, the stock has been trading under pressure in today's session. Earnings not that great as well. What do you make of the numbers?
The numbers have been very disappointing. To start with, we need to really understand that we are in a credit up cycle. All banks reporting very strong numbers. Yes Bank has seen the slippages at a three-quarter high. We understand that those slippages have come from four corporate accounts are one-offs and will not happen again in the coming quarters. However, in this quarter, the ROA, the ROE have been severely depressed, whereas all banks are reporting 1 to 2% ROA. Yes Bank has reported only 0.1 to 0.2% ROA on the back of the slippages being higher than estimated. So, in my opinion, the healing process for Yes Bank is in progress. It will require about 1.5 to 2 years more for the healing process to go on. This quarter's results are very disappointing when you compare it with all small and the large banks because there's a credit up cycle and the loan growth should also be very, very strong. We've seen that the loan growth is only at 11%, whereas the systemic loan growth is at about 18%. So overall, very disappointing numbers. However, Yes Bank will require a lot of time more to heal the wounds that it had got in 2019 and 2020.
Right. So, Aditya, would it be right to say that Yes Bank right now is particularly in a restructuring or a reconstruction process? And if so, how do you see the journey from here on?
Yes, definitely. So it will require about 1.5 to 2 years for this restructuring process to complete. We've seen that Yes Bank has gotten new investors on board and raised about 8,000 crores of capital, which will be helpful in writing off a lot of bad loans. We've already also seen that they have written off about 8,000 crores of loans to an ARC, where it will be off the books of Yes Bank. So, in my opinion, the deposit franchise will start to stabilize from here on. And once the deposits franchise really starts to stabilize, the loan franchise will also stabilize. It will require 1.5 to 2 years from here on minimum for the bank to stabilize its operations and for the investors to really rate Yes Bank as a banking stock. Right now, it is a stock which is really under reconstruction. We have seen about 25 to 40% of the book under real stress for Yes Bank, which is a huge amount of book for a bank. As you know, banks are a leveraged business, and if that amount of book is under stress, it means that the bank was on the verge of bankruptcy. So about 1.5 2 years, and the deposit franchise and the asset franchise need to stabilize.
So, Aditya, overall, if you see in terms of the kind of loan portfolios, they've sold a lot of loans already now. In addition, in the third quarter itself, we've seen fund infusion that's happened into the company. So, from that perspective, now when you jump down to the decision of writing down the AT1 bonds, what does that actually mean for the investors, according to you?
First of all, the writing of the selling of loans to the ARC is a strategic decision to take it off the balance sheet so that they can raise capital more effectively. That's a good decision from the current management. The writing off of the AT1 bonds was essential for Yes Bank at that point in time because if they did not write the AT1 bonds, the company would have faced bankruptcy, which is a very difficult task to handle. And RBI could not allow a scheduled commercial bank to have such difficulties because it would have a problem with the entire system. So it's a legal problem now of the AT1 bonds issue that has come up. However, the bank cannot afford even at this stage to even pay a small part of the demand of 8,400 crores because the bank makes just a profit of about 800 to 1,000 crores a year, and very, very difficult for the bank to give away that kind of money, considering the fact that the NPAs are still not provided for. So very difficult position for the bank, very difficult position for the shareholders of the bank. Only long-term investors who have about 5 to 7 years time horizon and who are willing to look away in the next 2 to 3 years can look at this now.
Right. So Aditya, let's make, investors would want to understand what would this write-off in terms of AT1 bonds actually mean. Now, clearly, the Bombay High Court, if you go to see in terms of the judgment that they've made, have actually set aside the stock exchange intimation and the bank's decision to write down the AT1 bonds. And at the request of the bank, the court has stayed the order for a period of 6 weeks. So firstly, on the basis of the legal advice that the bank got as well, now, in this 6 weeks, what is it that can happen? What are the scenarios we should work with?
So in this 6 weeks, Yes Bank has an option to go to the Supreme Court and appeal against this decision. We need to first understand the context of this. The context, Yes Bank had issued AT1 bonds. It means they are perpetual bonds with no maturity, and the bank had certain amount of coupon on it, which it had to pay. Now, under special circumstances, which include the bankruptcy of a bank, the bank has the power to write those bonds off. So they are a debt instrument with equity type behavior. The bank can write it off at will. So what happened in 2019 and 2020 as Yes Bank approached bankruptcy, the capital of the bank went down below the regulatory requirement of 8.5%. That gave RBI the power to advise that you need to write these bonds down because the bank is in no position to pay interest. So that was done. Then the bondholders who were holding the AT1 bonds went to the court, and it's since then the saga is really been going on. So what the High Court has said that Yes Bank cannot write down these bonds, and it has put a hold on the writing down of these bonds. However, I expect RBI, the government, and Yes Bank to come together and challenge this decision because Yes Bank today is in no position to pay off the interest or even partially pay the principal on the bonds. The bondholders are saying, don't pay us a full amount, but pay us some partial amount. Yes Bank is not even in that position to pay any amount. Yes Bank is not in a position to pay because the NPAs on the books has really swelled up. So what Yes Bank will do is Yes Bank together with RBI and the central government will go and approach the Supreme Court, and they will try to get a decision where the writing off of these bonds continue to stay. And that is in the interest of Yes Bank because if Yes Bank pays something, very good chance that Yes Bank again is on the brink of bankruptcy and more capital will need to be infused in Yes Bank.
Right. So Aditya, what if the decision is not in favor of Yes Bank and is actually in favor of the AT1 bondholders? Then what happens in terms of the financial aspect of the bank?
So I've read the 83-page report of the High Court, and it says that even the AT1 bondholders don't want the entire money back, but they want some partial money back. Point number one. Point number two is the financials of Yes Bank do not allow for Yes Bank to make any kind of payment. If under the Supreme Court's direction, if they are forced to pay, then the only logical solution for Yes Bank is either Yes Bank goes and merges with some other bank under the blessing of the regulator, or Yes Bank then goes ahead and raises even more capital, which will again mean dilution for existing shareholders, which is not something that the existing shareholders would really want. As you already see that the existing equity was diluted several times even after the reconstruction scheme. It is not in the interest of equity holders at this stage. And the third part is Yes Bank can go ahead and say to the bondholders that I'm allotting some sort of equity to you so that you are satisfied. That could be some sort of an out-of-court settlement between Yes Bank and the bondholders.
Right. And do you think it could have a knock-on effect in terms of the CET1 ratio as well as an increase in the AT1 capital ratio by a similar quantum? And if that happens, then what changes?
So if Yes Bank is forced to pay, of course the CET1 ratio will take a knock because that's the most liquid capital the bank really has, and from there the bank will pull out money. But I don't think the decision will come out so easily. I feel that the Reserve Bank of India will step in and it will try to go and convince the court that look, this is in the interest of the not only Yes Bank but the system as a whole, because RBI cannot afford to have a scheduled commercial bank face such a crisis, because it will then force uh, it will then cast a shadow on the entire small banking sector, small private banking sector, which is not something that the RBI or the government really wants. It wants the small private sector banks to really grow in this country. So
Right.
I think that the story is half done right now, and we will have a lot more. Yes Bank and RBI will have a lot more to say in the coming days.
Right. So, Aditya, overall, then what would you advise to one, an existing shareholder of Yes Bank to do? And two, from a long-term perspective, would you say it's okay to negate this overhang and enter the stock? If there are these two investors sitting in front of you, you're advising.
Ma'am, actually, there are very forceful investors who had a 3-year lock-in in Yes Bank,
Hmm.
RBI reconstruction scheme. Now we got no option but to sit in the stock, because anyway you've got nothing to lose. You've lost so much, 50, 60, 70%, that there's nothing to lose anymore, and the investment will already be written down if you go ahead and sell.
Hmm.
You have to hope that in the next 1.5, 2 years, after all of this crisis is done, you will find that Yes Bank is on the path to reconstruction, just as RBL Bank is. RBL Bank is reconstructing itself from the ashes. So you have to hope that over the next 2 years that happens. For a new investor, I will say there's no point entering the stock right now. The stock has a lot of hangover that is there on the stock. There are many other good banking sector stocks available where you can go ahead and invest. If you have a lot of money and you are a high risk investor and you can afford to negate your investment for 1.5, 2 years, then it's a good price point. As they say, good price and good news never come together. Right now, there's bad news, so the price may be good to enter. However, there could be a pain for next 1.5 years. So that's how investors should really
Hmm.
look at it. Average retail investor must not look at the stock at this stage.
Right. All right, Aditya. Thank you for giving us this detailed information to our investors as well, in terms of what this would actually mean for Yes Bank and what one should be doing with the stock overall. Thank you. Stay safe and speak to you soon again.
Thank you.